$517 billion, that's the amount of unrealized losses sitting on U.S. bank balance sheets according to the FDIC's most recent quarterly banking profile. Not projected losses, not worst-case scenarios, current unrealized losses on securities holdings as of the latest reported data. And if you think that number doesn't affect you personally, I need you to read something buried in your bank's terms of service, because while you weren't watching, multiple regional banks have quietly updated their deposit agreements, new language regarding withdrawal limits, new clauses about advance notice requirements, new provisions that didn't exist 2 years ago, not announced, not publicized, buried in legal documents that nobody reads. Your bank likely sent you an email with a link to updated terms. You probably deleted it like everyone else. But what those updated terms contain could determine whether you can access your own money when you need it most. While you were focused on interest rates and inflation headlines, something structural shifted in how American banks manage liquidity risk. 3 major regional banks failed in March 2023. Silicon Valley Bank, Signature Bank, First Republic, combined assets exceeding $500 billion, the second, third, and fourth largest bank failures in American history, occurring within weeks of each other. The official narrative said the crisis was contained, isolated incidents, poor management decisions at specific institutions. But here's what the official narrative didn't explain. The conditions that caused those failures have not been resolved. The unrealized losses that triggered deposit flight still exist on bank balance sheets across the country, and banks have noticed. According to deposit agreement analyses conducted by consumer advocacy groups and financial researchers, numerous banks have added or modified language regarding withdrawal procedures, reserve rights, and notice requirements since 2023. These aren't secret conspiracies. They're documented policy changes, available in public terms and conditions, changes that give banks more flexibility to manage withdrawal requests during stress periods. The question isn't whether these changes exist. They're in writing. The question is what they signal about what banks expect might happen. Now, let me be precise about sources before we continue. I'm drawing from FDIC quarterly banking profiles, Federal Reserve financial stability reports, SEC filings from publicly traded banks, and analyses of deposit agreement changes documented by financial researchers and consumer advocacy organizations. These aren't fringe sources. These are official regulatory documents and publicly filed corporate disclosures. I'm not claiming any specific bank is about to fail. I'm not predicting imminent bank runs. What I'm presenting is the documented pattern of policy changes, the historical precedent for such changes, and what similar preparations have signaled in the past. The data is public. The pattern is historical. The implications are worth understanding. By the end of this video, you'll understand exactly what changes banks have made to withdrawal policies, why they've made them now, and what historical precedent tells us about what such changes typically precede. Because here's what most people don't realize: banks don't update deposit agreements randomly. Legal changes require board approval, regulatory review, and careful consideration of customer relations impact. When multiple banks make similar changes during the same period, it signals shared concerns about scenarios they're preparing to manage. There's a documented pattern here, a pattern where policy tightening precedes liquidity stress, where fine print changes signal what institutions actually expect, where the legal groundwork for restricting access is laid quietly before access is actually restricted. Same sequence, same preparations, same quiet positioning before stress arrives. The only question is whether you understand what these changes mean while there's still time to evaluate your own banking arrangements, or whether you'll discover their significance only when you try to make a withdrawal that triggers new restrictions. Stay with me. The next 15 minutes will change how you read your bank's terms of service. To understand what current bank policy changes actually signal, you need to understand how bank liquidity crises develop, not the simplified version. The actual mechanics that have operated consistently throughout banking history. Every major banking crisis in modern history has followed a predictable 4-phase pattern. This isn't theory. This is documented financial history, studied extensively by economists and regulators. Phase 1, silent stress accumulation. Banks accumulate assets that lose value when conditions change. Long-duration bonds purchased when rates were low, commercial real estate loans in weakening markets, loans to sectors facing headwinds. These losses are unrealized as long as banks don't sell. They don't appear as crisis. They sit on balance sheets, invisible to most observers, but clearly visible to bank management and regulators. This phase can last years. Nothing appears wrong. Quarterly reports look stable, but stress accumulates beneath the surface. Phase 2, policy preparation. Bank management, seeing the accumulated stress, begins preparing for potential scenarios. They update legal agreements to provide flexibility. They modify internal liquidity procedures. They establish relationships with emergency funding sources. These preparations don't make headlines. They're buried in legal filings and internal memos. But they represent institutional acknowledgement that stress might materialize. This phase typically lasts 6 to 18 months before any public crisis. Phase 3, trigger event. Something causes depositors to question bank stability. A news report, a social media rumor, a failure at a similar institution. The specific trigger varies, but the dynamic is consistent. Concerned depositors attempt withdrawals. The volume exceeds normal patterns. Lines form. Digital transfers spike. The bank faces liquidity pressure. This phase develops rapidly, often within days or even hours in the digital banking era. Phase 4, response and resolution. Banks invoke the provisions they prepared in Phase 2, withdrawal delays, transfer limits, account restrictions, emergency funding from central banks or other institutions. The crisis either stabilizes through these measures and external support, or it cascades into failure. Those who understood the Phase 2 preparations had warning. Those who didn't discover restrictions when trying to access funds. Now let me prove this pattern is real. 3 examples. 3 banking crises, same preparatory pattern before stress materialized. 2007 to 2008, Washington Mutual. Washington Mutual was the largest savings and loan association in America, over $300 billion in assets, millions of customers, a household name in banking. By late 2007, WAMU's management knew they had a problem. Their mortgage portfolio was deteriorating, housing prices were falling, loan defaults were rising. Phase 1, silent stress accumulating in the loan book. What did WAMU do? They didn't announce concerns publicly. Instead, they quietly prepared. Internal documents later revealed in FDIC proceedings showed management discussions about liquidity contingencies. They established larger credit lines. They modified internal procedures for handling elevated withdrawal requests. Crucially, they updated certain account agreements to provide more flexibility in managing large withdrawals. Phase 2, policy preparation documented in internal records. Throughout 2008, sophisticated depositors began moving funds large accounts, business accounts, clients who paid attention to financial news. The outflow was steady but not yet critical. Then came September 2008. Lehman Brothers collapsed. Fear spread across the financial system. WAMU's stock crashed. Phase 3, trigger event. In the final 10 days before seizure, depositors withdrew approximately $16.7 billion from Washington Mutual. That's roughly 9% of total deposits in less than 2 weeks. The preparations made in Phase 2 weren't sufficient. The bank couldn't meet the withdrawal demands. On September 25, 2008, the FDIC seized Washington Mutual. Phase 4, resolution through failure. The largest bank failure in American history at that time, $307 billion in assets, seized overnight. But here's the crucial lesson. Those who recognized the Phase 2 preparations, those who moved funds before the trigger event, preserved access to their money. Those who waited discovered that being technically correct about deposit insurance doesn't help when your funds are frozen during resolution proceedings. Pattern established. Policy changes precede crisis. 2012 to 2013. Cyprus banking crisis. This example matters because it demonstrates the most extreme form of deposit restriction, outright confiscation, and because the warning signs followed the exact same pattern. Cyprus had become a banking haven, particularly for international deposits. Banks offered attractive rates. Deposits flooded in. Bank assets grew to over 8 times the national GDP. Those assets were heavily concentrated in Greek government bonds. When Greece restructured its debt in 2012, Cypriot banks faced catastrophic losses. Phase 1, silent stress, massive and obvious to anyone examining bank balance sheets. What happened next is documented in European Central Bank and Eurogroup communications. Throughout late 2012 and early 2013, Cypriot banks quietly prepared for scenarios. They worked with regulators on contingency plans. They reviewed legal frameworks for deposit handling during crisis. Crucially, they identified that existing deposit agreements and emergency legislation could provide mechanisms for restricting withdrawals if necessary. Phase 2, preparation, documented in later regulatory proceedings. Sophisticated depositors noticed wealthy Russians, who held substantial deposits in Cypriot banks, began transferring funds in early 2013. The outflow was significant, but not yet critical. March 16, 2013. The Eurogroup announced the Cyprus bailout terms for the first time in European Union history. Depositors would face losses to recapitalize banks. Phase 3, trigger event. Banks were closed for nearly 2 weeks. When they reopened, strict capital controls were in place, withdrawal limits of $300 per day, restrictions on transfers abroad, measures that lasted in various forms for years. Deposits above $100,000 at the largest bank faced losses exceeding 47%. Phase 4, resolution through depositor bail-in. Those who recognized Phase 2 preparation and moved funds before the announcement preserved wealth. Those who waited lost nearly half of amounts above the insurance threshold. The pattern held. Preparation preceded restriction. Those watching the fine print had warning. Silicon Valley Bank. This example is crucial because it happened in America recently, and because the speed of digital bank runs creates new dynamics that amplify the traditional pattern. Silicon Valley Bank catered to technology startups, and venture capital firms' deposits had grown enormously during the tech boom. By early 2022, SVB held over $200 billion in deposits. They invested those deposits heavily in long-duration bonds and mortgage-backed securities. When the Federal Reserve raised interest rates aggressively, the value of those securities plummeted. By late 2022, SVB had unrealized losses exceeding $15 billion the bank itself knew. Regulators knew. The information was in public filings for anyone who read them. Phase 1, silent stress, documented in quarterly SEC filings. Throughout late 2022 and early 2023, SVB management prepared for scenarios. They explored raising capital, they discussed asset sales, they reviewed liquidity provisions, they also updated internal procedures for managing withdrawal requests. Standard preparation that banks undertake when facing stress. Phase 2, preparation, visible in filings and management actions. On March 8, 2023, SVB announced they were selling securities at a loss and attempting to raise capital. Sophisticated depositors immediately recognized what this signaled. Within 24 hours, customers attempted to withdraw $42 billion. $42 billion in a single day. Phase 3, trigger event, amplified by digital banking and social media. The speed was unprecedented. Traditional bank runs developed over days or weeks. SVB's run developed over hours. Group chats among venture capitalists spread the alarm. Mobile banking apps enabled instant transfer requests. By the morning of March 10th, SVB was seized by regulators, the fastest major bank failure in American history. Phase 4, resolution through regulatory seizure. The government ultimately protected all depositors, including uninsured amounts, but that decision was discretionary, made under emergency circumstances. It wasn't guaranteed. It might not be repeated. What was guaranteed? Those who recognized Phase 1 and Phase 2 warning signs and diversified their banking arrangements before the trigger event didn't need to rely on emergency government decisions. They had already positioned appropriately. 3 examples, 3 banking crises, same 4-phase pattern, same lesson. Preparation. In the fine print precedes restriction in practice. Now let me show you where we are in this pattern today and why the current policy changes warrant attention. Let's start with the documented stress. According to the FDIC's quarterly banking profile, unrealized losses on securities held by U.S. banks peaked at over $680 billion in late 2023. While that figure has improved somewhat, it remains elevated at approximately $517 billion in recent reports. These losses are concentrated in bonds purchased when interest rates were near zero, long-duration treasuries, and mortgage-backed securities that lose value when rates rise. The losses are unrealized only because banks haven't sold. If depositors demand their money and banks must sell securities to meet withdrawals, unrealized becomes realized instantly. Phase 1, silent stress. Documented public, acknowledged by regulators. Now let's examine the policy preparation. Multiple regional and community banks have updated their deposit agreements since the 2023 failures. Researchers who track these agreements have documented several patterns. Pattern 1, advance notice provisions. Some banks have added or modified language requiring advance notice for large withdrawals. While many banks have historically had such provisions, the thresholds have lowered and the language has strengthened in some cases. Language, like the bank reserves the right to require 7 days advance notice for withdrawals from savings accounts, is not new. But expanding such provisions or adding them where they didn't exist represents preparation for managing potential outflow. Pattern 2, reserve rights language. Provisions stating the bank's right to delay, limit, or refuse transactions under certain conditions have appeared or been modified in some deposit agreements. This language is legal protection. It allows banks to manage withdrawal requests if they face liquidity stress without technically breaching their account agreements. Pattern 3, digital transaction limits. Some institutions have implemented or reduced limits on digital transfers. Daily limits on Zelle, ACH, or wire transfers that are lower than historical norms. In the SVB failure, the speed of digital withdrawals contributed to the rapid collapse. Banks have noticed. Some have implemented friction that slows digital outflow. Phase 2, policy preparation, documented in publicly available terms of service. Now, I want to be very clear about something. These changes don't prove that any specific bank is in trouble. Banks make policy changes for many reasons: regulatory guidance, risk management improvements, legal compliance, What the pattern does suggest is that the industry collectively learned from 2023. They're preparing for scenarios where withdrawal demands might exceed comfortable levels. They're establishing legal frameworks to manage such scenarios. That's prudent bank management. It's exactly what you'd expect after watching 3 peers fail in 2 weeks. But it also means the infrastructure for restricting access exists. The policies are in place. The legal language is written. If conditions warrant, banks have the documented authority to limit withdrawals in ways they couldn't have before these changes. The Phase 2 preparations have occurred. The question is whether a Phase 3 trigger emerges. Now, what conditions might trigger stress? Commercial real estate remains a concern. Office vacancy rates in major cities remain elevated. Loans on these properties, heavily concentrated in regional banks, face uncertain recovery. Interest rates remain elevated. Banks holding long-duration securities underwater cannot sell without realizing losses. As long as rates stay high, the stress remains frozen on balance sheets. Deposit competition continues. Banks must pay higher rates to retain deposits. Those higher rates compress margins. Profitability declines, making it harder to build capital buffers. Concentration risk persists. Many regional banks have concentrated exposure to specific sectors or geographic areas. A downturn in those specific areas creates outsized impact. None of these factors guarantee crisis. All of them represent conditions that regulators and bank analysts monitor closely. The pattern suggests we're in an extended Phase 2. Stress is documented. Preparations have been made. The trigger hasn't occurred, but the conditions for a trigger persist. Now I know what some of you are thinking. Let me address the counter-arguments directly. But my deposits are FDIC insured. I'm protected up to $250,000. True, and FDIC insurance is genuine protection. If your bank fails, you'll eventually get your insured funds back. But consider the word eventually. When IndyMac failed in 2008, some depositors waited weeks for full access to funds. When SVB failed, there was initial uncertainty about uninsured deposits that lasted days. Even if you're fully insured, having funds frozen during a resolution process creates real hardship. Bills come due, payroll must be met, opportunities are missed, insurance protects against loss, it doesn't protect against inconvenience and delay. But the government protected all SVB depositors, even uninsured amounts, they'll do it again. Maybe. The SVB decision was discretionary, made by officials citing systemic risk concerns. Will every bank failure receive the same treatment? Will a smaller regional bank with less systemically important depositors get full protection? Those are policy decisions made in real time by officials facing political and economic pressure. Assuming they'll always be resolved in your favor is a bet on future government decisions. But these policy changes are just routine legal updates banks always have withdrawal provisions. Banks have historically had provisions requiring notice for large savings account withdrawals. This is true. What's different is the timing and scope of recent changes. Multiple banks making similar changes in a condensed period following major failures suggests coordinated response to perceived risk. Individual changes are routine. Collective changes during stress periods are signal. But bank stocks have recovered. The crisis is over. Stock prices reflect many factors, including government assurances and improved sentiment. They don't erase unrealized losses from balance sheets. The conditions that caused stress in March 2023 still exist. Interest rates remain elevated. Commercial real estate remains challenged. Underwater securities remain on balance sheets. The crisis was managed. The conditions weren't resolved. They're waiting. But this is fear-mongering. You're trying to scare people. I'm sharing documented information from official sources. FDIC data on unrealized losses. Publicly filed deposit agreements. Historical patterns from previous banking crises. You can evaluate whether this information is relevant to your situation. You can check your own bank's financial condition through publicly available data. You can read your own deposit agreement. Fear-mongering presents false information to create panic. This presents documented information to enable informed decisions. The distinction matters. So what does this mean for you? Practically. Specifically, right now, I'm not a financial advisor. I can't tell you what to do with your money, but I can share what the data suggests and what historically informed observers have considered during similar periods. First, read your deposit agreement. Actually read it, not skim. Read. Look for language about withdrawal notice requirements. Look for reserve rights provisions. Look for limits on electronic transfers. Understanding what your bank can legally do is the foundation of informed banking. If you find concerning provisions, you're not powerless. You can ask questions. You can compare to other institutions. You can make informed choices. Second, understand FDIC insurance limits. $250,000 per depositor, per bank, per ownership category. If you have deposits exceeding $250,000 at a single institution, amounts above that threshold are uninsured. Government protection of uninsured deposits in 2023 was discretionary, not guaranteed. Spreading deposits across multiple institutions is basic risk management that the 2023 failures made viscerally relevant. Third, evaluate your bank's financial condition. For publicly traded banks, quarterly financial filings are available. For all FDIC-insured banks, basic financial data is available through the FDIC's BankRun tool. Look for capital ratios, non-performing loan levels, and the ratio of uninsured deposits to total deposits. Compare to peers. Understanding your bank's relative strength isn't paranoia, it's due diligence. Fourth, consider liquidity across institutions. If all your accessible cash is at a single institution, a freeze at that institution freezes your financial life. Maintaining some funds at a separate institution, particularly at an institution with different risk characteristics, provides flexibility if your primary bank faces stress. Not moving all funds, not panicking, simply ensuring you have options. Fifth, maintain some physical cash reserves. Digital systems can freeze, electronic transfers can be limited. Physical cash remains accessible regardless of banking system issues. A modest cash reserve is not hoarding. It's recognizing that bank access is not guaranteed during stress periods. The specific amount depends on your situation. Even a modest buffer provides options during disruption. Sixth, watch the indicators. News about your specific bank or banks with similar profiles. Changes in deposit agreement terms, regulatory actions or warnings, unusual management departures, significant stock price movements for banking sector. Staying informed provides early warning. Acting before triggers occur is the lesson of every historical example. If this analysis provided value, subscribe to The Silent Economy and hit the notification bell. I release new research weekly, and the next video breaks down exactly how to evaluate bank financial stability using publicly available data, which specific metrics most reliably predict trouble, and how to compare banks objectively. Drop a comment below. Tell me what you found in your own bank's deposit agreement, whether you're concerned about regional bank stability, what questions you have about banking system dynamics. I read every comment. This channel grows through engaged discussion with people who understand that the most important financial information is often buried in documents nobody reads. Here's what I want you to remember. Banks don't update deposit agreements for entertainment. Legal changes require effort, cost, and board approval. When multiple banks make similar changes during the same period, they're responding to something. The FDIC has documented $517 billion in unrealized losses. Multiple banks have modified withdrawal-related provisions. The conditions that triggered 2023 failures persist. Maybe nothing happens. Maybe rates fall, unrealized losses shrink, and stress dissipates naturally. That's possible. But if something does happen, the banks will be legally prepared. Their fine print already authorizes what they might need to do. The question is whether you've read that fine print, whether you understand what your bank can legally do with your money, whether you've positioned appropriately for scenarios that banks themselves are clearly contemplating. The pattern is historical. The preparations are documented. The conditions remain. You don't have to act on any of this, but you should at least know what's happening. At least read your own deposit agreement. At least understand the rules that govern access to your own money. The fine print doesn't care if you read it. It applies regardless. Thanks for watching The Silent Economy. And remember, the people who navigate banking crises aren't always the ones with the most deposits. They're the ones who understood the terms and conditions before they became relevant. The documents are public. The pattern is clear. The choice is yours.